Today we welcome Dr. Andreas Dombret at AICGS. He's a member of the executive board of the Bundesbank, visiting Washington in a crucial week, probably for the United States, but also for the global economy. And we have witnessed, Dr. Dombret, how the US has teetered on the edge of a debt disaster in this week. Do you think that what has happened in Washington will have a lasting impact on the global economy, or is it just a glitch?
I don't really want to comment on what actually happened or not. I would like to say the sort of impressions I had during my stay here. And actually I came last week's Tuesday, so I've been here now on the 11th day. I never had the impression whatsoever that the United States would come to a situation where they would not honor a payment, whether on the principal or on their interest. So while the situation in itself was, not an easy situation, that doesn't mean that the reserve currency status of the United States is in doubt, at least not to my understanding. It's good that we now have suspended the problem into the future. It should not come up all the time, but it should sort of look for a long-lasting solution. Clearly, there is a structural deficit in the budget, and one has to address that. But having said all of that, I never really was worried too much about this tail risk you are describing really becoming a major problem for the global economy. So not much has happened. Mm-hmm. You can see it in the credit default swaps. You can see it in the treasury auctions, which were not really oversubscribed, but also did work. So the world held its breath, but it didn't really come to a stop.
Perfect. This is very reassuring. You see certain parallels between the crisis management in the US and what Europe is undergoing and has undergone in the past few years, trying to overcome problems by managing crisis step by step, but always on the brink of a possible disaster.
I never really thought either that Europe was at the brink of a possible disaster. Where we really were close to a disaster was around about the time of September 15th of 2008, when Lehman Brothers failed and AIG was in danger, and other banks had been taken over, and the liquidity dried up, and the markets were not functioning as they are supposed to function. Then I felt closer to a disaster. Now, the European sovereign debt crisis is troublesome, because it came on top of the banking crisis of 2008, 2007, and amplified the problems we're having. But I thought that Europe, in all respects, worked together on this, sometimes a little bit more quick and sometimes a little less quick. So there is a similarity to what you just had here in the United States, but I don't think that the Euro crisis was ever brought Europe or the euro area to the edge of a crisis. If you, for example, look at the euro itself, at the currency, I don't feel it's a very weak currency, or that it, you never saw in the indicators that this was the case. We had a situation, though, that round about mid of 2012, there were tensions. There were serious tensions, but they have been overcome. The tensions came from the fact that in the euro area there was sort of a risk of redenomination, that the euro could break apart. It was at least seen as a risk, not as a 0% risk. In the meantime,
but as a tail risk.
As a tail risk, the insurance sector would call it a catastrophe risk, a cat risk. But this risk, the redenomination risk, of the euro breaking apart, I don't see anymore. Most people don't see. And I never saw it even in 2012, but the market had sort of suspicion that this could happen. Mm-hmm. And more so than last week, I may say, in the United States. But this is overcome. You can now see money flowing back into the euro area and also into the European Union. You can see this even in the periphery quite a bit. You have much more investment in Greece than they used to have, which is good. You see the export markets picking up. You see the rebalancing of the euro area starting and staying on course. You see the euro area having left recession and growing with a growth next year, which is not very large, but of course much better than the recessions we had. So the overall euro area is rebalancing and has very much bottomed out. So I'm quite confident that this will continue.
This is the upside, and of course, growth in the euro area also hinges on a functioning financial market, and particularly for European SMEs, who are the engines of growth, not only in Germany but also in the periphery of Europe, largely hinges on banking loans, bank loans.
Even more so than in the United States.
Even more so than the United States.
That's right.
For 75%, I think, is the ratio in Europe versus 25% tapping into capital markets. Do you think that the European banking system as a whole is on the right track? Or do you fear that the asset quality review that the European Central Bank will undertake in the coming year will reveal some weaknesses that could bring about some disruption or at least volatility in financial markets?
What I feel is really not that relevant and probably a little bit biased. So let's look at the facts. Since the outbreak of the crisis, 2007, 2008, European banks, very much also German banks, have increased their equity. Capital buffers are larger now, and they are much more resilient to shocks than they were before the crisis. There's still legacy assets around, which will now be looked at in the exercise the ECB will conduct with the help of the national central banks, of course, also with the help of the Bundesbank next year. So the facts are we are in a better shape, and we will have a reality check next year, which is the right thing to do. Everybody agrees that this reality check has to be credible as possible, and I don't think there are going to be many compromises, but the announcement on what actually will really happen in the AQR and the stress test will come later this month, and I don't want to prejudge that.
This is how the AQR will be
Yes.
will be undertaken. What we also need, or at least the European Central Bank has tried to stress this point repeatedly, is a system of credible backstops or a centralized backstop in order to lend credibility to this exercise,
Yes.
so that the European Central Bank and the national central banks can actually take a proper look at the balance sheets of banks.
That's not a precondition, if I may correct you there. The ECB and the national central banks will take a proper look, no matter what. The real question is then, should there be gaps identified? What is going to happen then? But that there will be a proper look and that this will be a credible exercise, that's not in question.
And how important is a credible backstop in your view?
Very important, and that's why the ECB, for all the right reasons, is asking for that. You cannot have 17 countries embracing the idea of a banking union and of a credible stress test and of a credible asset quality review and saying, well, we are not, my banks are not going to be having any gaps whatsoever. We have to go into this exercise with a very open mind and a very fact-based exercise with the same high standards across the euro area. Only then it will work. We have had an experience of 2 stress tests, which were, if I want to be diplomatic, were not perfect in terms of acceptance. We have to get it. We have to get it right this time. So, and I think everybody knows that. Everybody's working on that. The EBA is much better positioned in doing that. They were a very young organization. In the case of the first and the second stress test, I don't have any reason to believe that this third stress test will have the same weaknesses and flaws as the first 2. So I would assume that Europeans can learn from not so good experiences in the past.
And let's look at some of the weaker spots in the euro area, especially when it comes to banks. I mean, part of the reasoning behind establishing a banking union is trying to cut what some call the vicious link or vicious circle between sovereigns and banks, or the negative feedback loop between sovereigns and banks. Where do you think we today? I mean, has there not been a renationalization of banking systems within the Eurozone? Are we not still witnessing fragmentation across the Eurozone? Are we not seeing, particularly in the case of some of the peripheral countries, that banks, when they received generous loans by the European central banks, instead of passing on these loans to the real economy, have increased the purchases of national sovereign debt? You know, the case of Italy or Spain is very striking in that respect. So,
yeah, no, the fragmentation worries me. You know, there's always this example of a company in the same sector, let's say of a hotel in northern Italy and in southern Austria, having very different rates when they borrow, very much coming from the sovereign rating of those countries. This is not something which we really like. There will always be differences in ratings, of course. So there are always going to be different rates to borrow, but the fragmentation is a little bit high. And so that's something I find too pronounced in a negative way. So that's a weak spot. And this is why the rebalancing of the economies has to continue, especially also in the periphery. And this is why, if there should be reform fatigue, this would really be a problem. And we are really urging governments and treasuries to continue on the path of structural reforms.
Do you see complacency?
That's a very broad question, and you would have to go through country by country to answer that. But I warn out against complacency. With regard to what you mentioned, the nexus between banks and sovereigns, that is, of course, something which also is on a different level in several countries, but it's troublesome in some areas of the euro area. And it's something we need to break. And the banking union is a very important measure to do that. If you think about the banking union is really, in my opinion, the single most important step since the introduction of a single currency, the euro. So it's very important we get it right, and that's why we're supporting it. Now, with regard to breaking the nexus, the Bundesbank has tabled a couple of suggestions in order to address that, because it is worrisome. And one of the suggestions really was to say, is it correct that the risk weights for the sovereign bonds for banks is zero risk weighted? Is that correct? Wouldn't you think that there is a difference between, let's say, a French government bond and a Greek government bond, or pick other examples? Of course they are. When you deposit a French government bond and a Greek government bond with the ECB, you're going to have different haircuts. So when a bank lends to corporates, even to individuals, depending on the rating of those corporates, there are going to be different risk weights. Why isn't that the case? Why is there zero risk weighting, the correct risk weighting for sovereigns? So that's one thing we have been addressing. And the second thing we've been talking about is, why shouldn't we really cap the exposure in sovereign bonds of one bank in relation to its capital? Diversification is the golden rule of banking, or one of the golden rules of banking. And if you put all your cards into one borrower, even if it's your national borrower, your home, your host sovereign, so to say, that is not the right thing to do. So this is not imminent. These are thoughts which we are discussing, which is not going to come tomorrow.
So they wouldn't be part of ongoing...
It's not in Basel III, as you know, but nevertheless, you have to think things through, and just because they are not convenient doesn't mean you shouldn't be thinking the thought. But we have to address the bank sovereign nexus, as you say, as you rightly say so, and the banking union is addressing it, and we're going to even think beyond that. Eventually, we will have to rethink a zero risk weight on sovereign bonds, and we have to think about capping the exposure to one single sovereign vis-a-vis the capital of a certain bank.
Do you think that, looking at the sort of wider narrative of the banking union, that banking union has also a strong political significance, because it would be the first time during this crisis that all member states actually give up some of their sovereignty, of their control over banks, to a centralized institution, in this case the European Central Bank, and eventually a resolution authority? It's a symmetry.
If you have a central monetary policy, as we do, as you do also in the United States, if you have that, to have a centralized supervisory authority with the same high standards makes a whole lot of sense to me. It even supports monetary policy in a way. And this has to go hand in hand with a centralized resolution and recovery authority, because if you as a supervisor don't have a credible threat towards your banks that you can resolve them in case there's an issue and a need to do so, then you are also not, you don't have all the instruments a supervisor is supposed to have. Mm-hmm. This goes hand in hand, and that's why we are asking that the single resolution and recovery mechanism should start preferably at the same time as the single supervisory mechanism.
Which is the end of 2014.
Which is around that time frame, that something like that, whether it's the end of 2014 or the beginning of 2015, that is, I don't want to mention any date here, but this is the time frame of what we're talking. Mm-hmm. And so that's what we would like. We would like the resolution and recovery mechanism to start at the 1st of January 2015 rather than 2018, mm-hmm. as it is still envisaged.
Perfect. Now, you mentioned the date of 2015, and if we try to zoom in on some of the monetary policy tools that the ECB is currently deploying and using, the beginning of 2015 is also the time of the expiration of the current LTROs. So a lot of banks have repaid their loans to the European Central Banks. Some haven't. There is still a need to get credit flows back up, and that hasn't happened, particularly in the periphery of Europe, in order to sustain growth. Do you think that extending the deadline, extending the maturity of these LTROs is a possibility, or could possibly be needed in the next few months? What is the position of the Bundesbank on that?
I'm not a member of the Governing Council, and that's ultimately a decision of the Governing Council. And Jens Weidmann is presenting the Bundesbank at the Governing Council, and he will then, put forward his position when the vote is up. We're talking about something in the future, so I don't really want to comment on that at all.
Mm-hmm. And the need to provide SMEs with credit in the absence of the full banking union that we just discussed, in the short term, what would be possible, do you think?
The European Central Bank is in full allotment mode, has done a lot to ease tensions in the money markets. We can talk about not only full allotment, but reduction in the interest rate. The collateral framework has been loosened,
which you have criticized.
And, yes, depending on, but still, if there's a decision of the European of the Governing Council, that's what it is. Mm-hmm. And I am going through all those measures, and you mentioned LTROs. There were two of those. You had an SMP, and you had a purchase program of mortgage bonds, etc., 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 etc. So I wouldn't really say that the ECB and the national central banks, the euro system as we call it, is not doing what it can to ease tensions on the money markets, very much so to keep the real economy as unaffected as possible, mm-hmm. from this sovereign debt crisis and the banking crisis. Now, I agree with you that in some peripheral countries, credit growth is not what it could be and what it used to be. There is also some deleveraging going on. In the case of Germany, which of course I know best, some of this deleveraging is, being asked for. The EU Commission has ruled that a couple of Landesbanks are deleveraging, so there's nothing to be criticized. It is in the the process is the right process and not a contested process. Not every deleveraging is unhealthy. There have been a couple of projects I remember from my time as bankers where you finance 30-year windmill projects outside of Florida with a 3 basis points margin. I'm not so sure that this is a perfect mandate to perfect exposure to have. So what I'm trying to say is not all deleveraging is perfect. Nevertheless, we're not seeing the credit growth in some countries we would like to, and they need to in order to grow. So that's why the Euro system is doing so much, ever so much, to help support the real economy. And mostly this has worked, considering what kind of decrease in growth we saw in 2008, 2009, where, for example, the German economy shrunk by more than 5%. Mm-hmm. This is only the second time this happened after World War II. The first time it did shrink by 0.5%, 0.5%, yes. Which tells you what kind of problem there was. I think we are really doing everything in order to help, ease tensions, in order to protect the real economy from those tensions in the banking markets and also from the sovereign debt crisis.
A final word maybe on non-standard monetary policies. Obviously, central banks around the world, at least in advanced economies, if they, with a magic wand, could choose, they would probably say, conditions should improve overnight, and then we can finally go back to being a proper central bank and just take care of the basics. What's your view on the exit strategy, and how much more time would it probably take for at central banks of advanced economies to get out of non-standard monetary policies?
It took us a long time to get into the sovereign debt crisis. So it's also not going to be possible to exit in the real short term. Mm-hmm. Plus, the getting out of this crisis is going to be difficult for societies, not only for central banks but also for societies, and it's going to be unpopular.
Some say it will take 10 years, probably.
Exactly, but I'm not going to speculate on the time frame. All I'm trying to say is what needs to be done to get there. The most important thing from our point of view is that there is no real contradiction between austerity and growth, but both has to be there. You have to probably start with some sort of austerity because of the high borrowing levels of governments in the past, and governments in some countries not being able to borrow in the markets anymore. If that's the case, and if you add
there's no choice,
debt to that, you're not going to get rid of the crisis of confidence in which we're in. Mm-hmm. So, but austerity and growth has to go hand in hand. Yesterday, in a speech nearby, I called this the yin and yang, and it is complementary. It's not an either or, but it's more of a matter of degree, if you wish. So, having said that, that's what we need to do, and depending on how well we do this and how well governments follow through with the structural reforms, the shorter the time is. Otherwise, it's going to take longer. But we have to be realistic that, of course, the crisis didn't just break out and was there, but there was a longer building up time. So it will not be short, and it will be difficult, and it will be challenging, and it will, of course, be unpopular, unfortunately.
Mr. Dombret, thank you very much.
Thank you very much.